Hello, everyone, and welcome to the NASDAQ Dorsey Wright Monday Analyst Discussion for this Monday, June 22nd. My name is Ian Saunders, and joining us here this week is Eric McArdle. And we're coming in here this week to a continuation of some of the volatility that we've seen over the past couple weeks here. Taking a look right now at the 20-point chart of the S&P 500 index, ticker SPX here on the platform. You can see the 20-point chart by navigating over the left-hand side and clicking on the 20-point under the other scales. And in bringing up this picture, this is really the main kind of picture that we've been focusing on for the broader S&P 500 throughout much of this market movement that we've seen over the past several months. And we see that this index continued higher to reach that 3220 level at the beginning of this month before undergoing that continuation of volatility that we've seen over the past couple weeks. We returned to a buy signal there last week up at that 3100 point, continued a bit higher over the remaining days in the week. And then we come in here this morning with the market dropping down a little bit this morning to reverse that chart back down into a column of O's at the 3080 level that we see, at least as of trading at the time of this recording. And then we also see as well, you can see directly above in the upper right-hand corner of this page, that even though we did reverse down into a column of X's this morning, that the S&P in and of itself is actually posting a little bit of a gain here today, up about 0.5% here at the time of this recording. And that speaks to a lot of this volatility that we've seen over the past couple of weeks. Obviously, the past several months have seen a lot of volatility from a day-to-day perspective, looking at variations with market might be up a few percent one day, down a few percent the next day. But interestingly enough, if we actually take a look at the intraday movement during the trading day on an intraday basis, we had a piece in the report last Friday looking at the number of days that has seen at least a 2% swing or 2% difference in the high and the low values for the S&P 500 index on an intraday basis. So the daily highs and lows, at least a 2% difference there, and then counting up the total number of days that we've seen that movement so far this year. And we're actually up to, at least through Friday, June 19th, up to 46 days on the year that we've seen at least that 2% difference in the high-low. So a lot of intraday volatility. That's actually the highest reading that we've seen on that since the 2011 timeframe, when we had 69 days from there. So definitely a lot of movement that we've seen going on in the market from a day-to-day perspective, as well as on an intraday basis. And that's led to a fair amount of movement underneath the hood of the domestic equities asset class. From the broader perspective, taking a look at the domestic equities asset class, we have seen that asset class rise from a longer-term relative strength signal perspective over the past several weeks, but it's still sitting there in that third ranking overall. So it's gained buy signals relative to the other asset classes, but then it still remains in that third ranking out of the 6 broad asset classes that we have examined. But if you take a look underneath the hood, and one way to do that is through the sub-asset class view that we're viewing here currently, you can see some of the movement that we've seen within the asset class over the trailing month period. So looking over a trailing month, you can see here the different breakdowns for each of the areas within domestic equities, specifically looking at your size and style comparisons there, as well as the U.S. sector perspective. And the point that you want to look out for here is that your dots on the page are going to be where your buy signal counts would currently be relative to the relative rankings that we have among the buy signals within each breakdown. But then the trailing bar, either to the left or right of that dot, is going to show you where those signals have moved from over the past month. And so coming in here, looking at the size and style breakdown first, we can see that on the U.S. equities side of thing, that large cap growth breakdown is still in the number 1 ranked spot with 160 buy signals, but has fallen off a little bit from a buy signal perspective over the past several weeks to now sit just 1 buy signal above the mid cap growth space there with 159 buy signals. And that's speaking as well to a lot of the near-term strength or the laggard rallies that we've seen from some of the small caps and from some of the mid cap spaces over the past several weeks here. And those rankings is that close proximity in nature of the large cap growth and the mid cap growth space is something we see reflected also on the asset class group scores page. So it's good to see that consistency between the two variations of rankings that we have on the platform. And then in looking down at the lower end of these rankings, we see that small cap value is still going to be in that last ranked position on this breakdown, but we've seen a fair amount of signal improvement from that space over the past month. Moving up to its current level of 48 buy signals. Again, still in the last ranked spot, still sitting 8 buy signals below that mid-cap value space, but definitely seen a fair amount of consistent improvement here over the past several weeks on the backs of that kind of laggard increase in participation that we've seen across most of the domestic equity market over the past few weeks here.
Yeah, Ian, and with the laggards coming up and really seizing the later part of May and then ultimately softening as we got further into June, what that's done here is just from a conceptual standpoint, is it's really narrowed the field, right? We had this wide level of leadership difference between large cap growth and small cap value. And while that leadership remains intact, right, we haven't really seen any major size or style changes. It does show that we are narrowing a bit. So we're seeing a market that's narrowing in the middle, and the leadership is moving toward that middle respectively, as are the laggards, right? And so if we look at one of the laggard constituent funds using the Vanguard Small Cap Value ETF, ticker VBR, on an absolute basis, coming off the market bottom in March, this fund has done pretty well, right? We've seen it most recently mark 2 consecutive buy signals, move back to a positive trend in May. So on an absolute basis, improving here. However, when we look at that relative basis, and I know we just looked at Dolly, where we're seeing some buy signals move back into the picture for small cap value. But we're still in that last place ranking, right? So coming off the bottom, so to speak, from a relative strength standpoint. And that's going to really match up with the fund score as well. So like you said, Ian, when we're looking at Dolly, when we're looking at asset class group scores, we can see a similar ranking based on the idea that a fund score between 0 to 6, generally a 3 or lower is going to be an unacceptable score from an absolute and relative strength perspective. So, not necessarily saying the laggards are coming back, right? Over the last 30 days, VBR is up 7.36% relative to the S&P 500, up 4.24%. However, on a year-to-date basis, that relationship is still very, very wide. Small cap value here with VBR down 21.5% on the year versus the S&P 500 down about 4%. So not a leadership change yet, but as we see the volatility remain in the market, don't be surprised if you see these laggards make big moves up in mean reversion events, and then as we saw 2 weeks ago, can pull right back to soften a little bit. So just be on your toes with that.
And another area we've seen seeing some rotation within domestic equities asset classes on the U.S. sector perspective as well. So the size and styles have seen a little bit of movement there, but we've seen a little bit more movement from some of the individual sectors that we have broken down on that sub-asset class view. You can see there that over the past month, we had the energy sector rise significantly in the Dolly rankings to move up into the top ranked position in the Dolly US sector breakdown there, with the buy signal count of 208 buy signals that it has here currently, at least through the end of trading there on Friday. That's something that's been a point of the research that we've had over the past couple weeks there since that move did occur. We've seen many energy funds come into many of our models that we have across the platform. But it's important to note as well that we still have technologies really high from a relative strength perspective. Even though it's not in the top ranked position anymore, it's still sitting solidly in that second ranked spot with 194 buy signals, separating itself by 24 signals from the third ranked consumer cyclical that we see there. And we've seen a fair amount of follow through and improvement over the past few weeks here within the technology space in and of itself. One way that we can take a look at that is through looking at some of the other major indices that have a particular overweight towards technology, such as the NASDAQ 100 index, ticker NDX. And looking at the bullish percent for the NDX, again, the bullish percent charts are going to be looking at the percentage-based charts, looking at the percentage of stocks and whatever inventory you're evaluating that are in a current point and figure buy signal. So here, looking at the bullish percent for the NDX, looking at the percentage of names in the NASDAQ 100 index that are currently on a buy signal on their respective point and figure charts. We saw that chart move significantly lower there after reaching a high earlier this month there at 88, pulled back down to that 68 level, and then following trading on Friday, reversed back up into a column of X's at the 74th percentile there. So that what that's indicating is that it's telling us that we're seeing more participation from these names in the NASDAQ 100, more names moving to buy signals. And we're continuing to remain at this elevated territory that translates over to the broader NASDAQ 100 index of itself, moving back into elevated territory as well. Is that right, Eric?
Yeah, it is, Ian. And I think, this has been such a focal point for us in talking about the strength of the NASDAQ 100, the strength of the respective ETF that many of you are familiar with that follows the NASDAQ 100, the QQQ ETF Trust. And of course, you've got your big mega cap tech names that make up a large component of this index, about 45% between the FANG stocks, as they're called, right? But that BP, as you pointed out, Ian, with a level now above 70 back up in X's, that tells us that it's not just those mega cap names driving the index higher, right? There's a wide level of participation there. And we've seen that reflected in the chart for the NDX, right, where we saw a reversal up today in trading, and we are within striking distance now of that all-time high at 10,140. So something to monitor when we continue to watch for, expanded strength for this index and for this group of stocks. It's really held up the market, all things considered. And if we pivot a little bit, Ian, and we look at a similar area within the technology sector, right, of course, which, as you pointed out, and Dolly has been a long-term leader within those top three rankings from a sector perspective since 2016. So very consistent there. In today's report, we're going to take a look at cloud computing stocks, and those are a subset of the technology sector, focused on a specific area of the sector that provides, as the name implies, cloud computing services or database products. And when we look at one of the sector proxies using the First Trust Cloud Computing ETF, SKYY, I think this is one of the best charts just from a aesthetic standpoint that I've seen all year, Ian. Looking at this coming off the bottom, we're on an 8th consecutive buy signal, have consistently moved past resistance, moved past an all-time high that was set in February to today's current all-time high of 73 on the chart. With that action, Ian, Sky is positive on the year, over 20% from a year-to-date return perspective, pushing its fund score to 5.65 out of a perfect 6. So extremely strong there. And another cherry on top for endorsing SKYY is that weekly OBOS reading, right? You would expect with this much success that we would have an elevated reading on that front, indicating an overbought fund. But we are still within actionable range here. And with this chart pattern moving up and continuously stair-stepping higher, we also have support at multiple rungs all the way down back to that bullish support line. So a really strong picture. If you can't tell, I'm excited about the fund, and I think it's going to be a great area to pull stocks from in today's report. But if for whatever reason you want to get ahead of us on that front, one way that you can look under the hood on this fund or any others on the platform is by clicking the All Holdings link. And then from here, you're going to be provided a list of the holdings sorted by their respective weightings with their technical attribute or fund scores listed on the side. You can always then send to a portfolio or a matrix using the Dorsey Wright shuttle tool. So, I'm really excited about this fund, Ian, if you can't tell. But I think the point here is technology continuing to show not only near-term strength, but lasting through with the long-term continuation of high RS here.
Absolutely. And I mean, there's a fair amount to be excited about across a lot of spaces within the domestic equities. And this is certainly going to be one of those there. I mean, on the backs of the continued quarantine concerns, how long stuff's going to continue. I mean, the cloud computing aspect, that technology aspect of it, definitely I'm seeing some further follow through to the upside there the past couple of weeks. And on the backs of all of this continued volatility that we mentioned at the onset of this video, This is something that we're going to be continuing to take a look at, these areas we mentioned today, as well as other areas, things that might be occurring as we continue on over the next week or so here. So we'll continue to bring any and all of those to your attention, whether it be through the daily equity report that is going to be published each and every day there under the research tab, as well as through this video and through other media outputs, such as our podcast, which is recorded there on Wednesdays. So a lot of content that'll be coming your way here and that will continue to come your way. If you have anything in particular that you're interested in or you feel like we should take a look at, definitely don't hesitate to reach out to us, whether it's something that you want to look at individually or whether it's something that you think might be pertinent to bring to the broader audience. Don't hesitate to give us a call. We're always available during normal business hours here at 804-320-8511. You can see that number right here on this main page that you should come to when you log into the platform. If there's anything you wanted to bring to our attention, but you'd rather type it out rather than talk about, you're more than welcome to shoot us an email as well at dwa@dorseyright.com. So with that, Eric, I think we touched on most of what we were looking to cover here this afternoon. So I want to thank you all very much for joining us here this week, and we look forward to speaking with you again soon.